All right, guys. So welcome back. Now we're on replacing a fixed asset. Now, if there's anything we probably can all relate to is replacing a fixed asset. So maybe you have a car and now it's barely getting the mileage you need. It's breaking down on you. So now you're trying to decide, hey, do I stick it out a little bit longer and do the repairs to it? Or do I go out and just go ahead and buy another car, right? That is the decision that's at play for business. So when we're looking at replacing equipment, we recognize that the usefulness of fixed assets may decrease by before it's completely worn out. And so that old equipment may no longer be as efficient as a new piece of an equipment. So therefore, we're trying to go through this analysis financially to see if it makes more sense to stick with one alternative versus the other, okay? So here's some information that we have. We have the old machine, the book value of it, the annual variable manufacturing cost, the selling price, and the remaining useful life. Then we have information on the new machine. So the purchase price, the variable manufacturing cost, residual value, and the useful life. So given this information, here's our differential analysis. So let's break this down step by step. So in alternative number one, if we continue with the old machine or if you continue with your old car, we're not selling it, right? That's the first one, is there's no revenue because we're going to keep our car. Chick, chick, boom, boom, or our whatever you call it, right? We're going to keep rolling with it. So there's no sale. That's also no subsequent purchase because we are just going to keep rolling what we have. Now, our variable manufacturing cost for 5 years is $1,125,000. So how did we come up with that? Well, it tells us, if we're looking at the old machine information, it tells us that our variable manufacturing cost is $225,000. And if we multiply that times 5, because it's 5 years, right, we're going to come up with a loss of $1,125,000. Now, if we go forward and decide, you know what, I've had enough, or, man, it's going to take so much more energy to continue to work with this old machine. Let's think about alternative number 2, which is to replace it. Then we have some all new information that we have to consider. Now, the first one is in alternative number 1 is the proceeds from the sale of the old machine. Now, it tells us that in here, if that we decided to sell this machine, we would get $25,000. So that would be considered revenue for us, right? It will help offset the cost of buying a new machine. All right, so the purchase price of the new machine, they tell us, is $250,000. It's a minus because we're buying it, we're purchasing it. And then our variable manufacturing cost is $750. So very similar to what we did for the old machine, we're going to look at our variable manufacturing cost, which is the $150,000. We're going to multiply that times the 5 years, and then that's how we come up with a negative $750,000. Now, it's important to note here that the variable cost of goods, or the variable manufacturing cost, is significantly less with a new machine because it's new, right? Everything is functioning as it should. It's cutting the wood or the parts as it should. It's not wasteful. Everything is just top notch. So that is the reason why the manufacturing cost on the new machine is a lot less. Now, if I can make this point more relatable to you at home, is when you first buy a car, you don't need an oil change right away or a lot of maintenance on it, and it's getting the perfect, miles per gallon because it's new, right? It's calibrated and it's working perfectly. Versus maybe down the line, you have some wear and tear on it, and it takes a little more to operate the vehicle. All right, so if we compare the two alternatives, alternative number 1 and alternative number 2, what you should take from this is that it would be advantageous for the company to decide to replace the old machine with a new one, right? this is the best decision because it's saving them a lot more money to replace it than to continue with it. In fact, it's saving them $150,000 more by replacing it versus continuing with the old machine. And again, that's so relevant. Like, I know when I was buying a car, or before I bought my car, I had a Toyota Solara, and it was an awesome car, but I think the transmission or the radiator went out. And so the estimates they were giving me to replace those those main things, it was almost not worth to replace it, only for something else to go wrong. And so those are the decisions we're making here. Like, hey, it's not really worth it. And plus, this is a 10-year-old car. It's likely something else will go wrong. So instead of pouring more money into the car, I just took that same money and used it as a down payment on a newer car. Okay. All right. So hopefully that made sense to you. So here we are with this one. I would say you guys give this one a shot and work through this one. All right, so it says a machine with a book value of $80,000 has an estimated life of 5 years. A proposal is offered to sell the machine at $50,500 and replace it with a new machine at a cost of $75,000. The new machine has a 5-year life with no residual value. The new machine will reduce the annual direct labor cost from $11,200 to $7,400. So let's see what this would look like. Okay. So again, this one is a bit tricky because it makes you think, or you have to fill in some of the missing parts. Okay. So to go through this, let's look at alternative number 1 is to continue with the old machine. So again, we're not going to sell the machine, so there's no proceeds from the sale of it. There's no purchase price because we're keeping it. But the way we come up with the $56,000 is we're looking at this amount, right? So if we did, we're talking about the cost of operating this old machine. So it would be $7,400 times the 5 years to come up. Oh, I'm not doing that right. I take that back. All right, so let me read through this again. So it says a proposal is over the sale, replace them. Oh yeah. So I'm doing the wrong number. Sorry guys, that's my bad. All right, so what I should be doing is calculating this, because it's saying the new machine will reduce the direct labor cost from meaning this is the old machine and this represents the new machine. So to calculate our direct labor costs, it would be $11,200 times 5, and that's our $56,000 here. Okay, and to replace the old machine, alternative number 2, we get these figures here, right? So proposal is offered to sell the old machine at $50,500. So that would be the proceeds from the sale of it. And to purchase a new machine, it will be $75,000. And so then if we're looking at our direct labor, right, this represents our new machine, how it will reduce our direct labor costs. And so we would do $7,400 times the 5 and come up with the $37,000, and then do the differential. So in looking at these two alternatives, it would make more sense for us to continue with the old machine versus buying a new one. We are saving $5,500 by deciding to continue with our old machine. Okay. All right. So hopefully that made sense to you guys. In the next video, we're going to continue on to the next one, which is selling the product or process.